All right, team. Today we have Disney earnings dropping pretty soon. Not gonna be too far away here. We're gonna do a poll like we always do. It's Q1 earnings for Disney. Earnings come out pretty soon. We got some time. What's up, Sandy, Corey, Kieran? Hey, what's up, team? We got Robinhood Affirm earnings today as well. Sonos. So we got a couple things with earnings. Can you hit the music? Let me know. We had AMD earnings in tech today. Disney earnings. You see Disney right around 111s, consolidating around 111s. What's up, Steve, DS, Sandy, Corey, Kieran? Hey, what's up, guys? But yeah, can y'all hear the music? Yeah, we'll cover APPS as well. Don't worry. Yeah, we'll cover that. We'll cover all the major ones for sure. Full call will begin streaming here at 4:30. So I like Disney. They're a little bit early. All right, team. Let's get this scrolling at the bottom here. It's been a pretty good few days here, to be honest here. So we are green over the last couple of days. Again, here is my profit graph. Today we made a nice little couple $100 here. Yeah, we made about 230 today, 225. So not a bad day so far today, about 226. Not bad. We will take it. Our win-loss ratio today alone is almost 2-1. So we win almost twice as much as we lose today. And yeah, we'll see if we can keep this up. You can see the full week's profit graph here. We track, since February 1st. We've been doing pretty good. And we'll see if we can keep it up. Yeah, but we also have a lot of other earnings today. So we also have IZEA, Disney, Affirm, Robinhood, Digital Turbine, Sonos, O'Reilly Auto Parts, Wynn Resorts, Equifax. We got MGM dropping earnings, and a bunch of other ones too. So we're gonna do a poll like we always do here. And again, on this poll, let me know what you guys think. If whether you're bullish or bearish on these earnings. Again, we're gonna do a call live. We'll cover all the other ones as soon as they drop. I remember it's bull or bear on Disney Q1 earnings here. Vote on that poll. We got that poll live. We're also going to do a Twitter poll like we always do here. Let's see if this affects Netflix too. I'm curious to see whether it does. We also have Robinhood. Also have Hood and Affirm. Yeah, so I like this one. The earnings are a little bit sooner after the closing bell, so I don't mind that. But yeah, we're going to do a calls or puts poll here. Let me know on Twitter. Still make it 2 hours. All right, so we got the Twitter poll live like we always do. What's up, Nathan? Yeah, so you see Disney is right around 111s, right around 111s. Looking at our poll numbers here, we got about 52% saying bullish, 48% saying bearish here. Let's go ahead and look at our Twitter numbers real quick if we can. If you want to vote on this Twitter poll before we do that, I guess here is that link if you want to check it out. So Disney earnings dropped right at the closing bell. So right at 4:05, Disney earnings will come out. Full call will begin at 4:30 p.m. All right, so we're gonna put this up so you can see it as well. Here's the full list of kind of numbers for everything. Yeah, I mean, I hear people say that all the time. Like, to be honest, like I'm more interested in making money anyway from Disney. People could say whatever they want about them. Most of it's just speculation, or again, I'm not saying it's not true. I'm not saying it's true either. I really don't know, but I look at value in terms of earnings, EPS numbers, PE ratios, and Disney is usually pretty profitable as an investment. We also have Robinhood earnings today too, which would be interesting. I mean, we cover Robinhood. Disney's going to move the market more than Robinhood, I think, but I'm going to send our newsletter out here as well if we can. All right, cool. We're creating our campaign. And again, if you want to join on to our newsletter, we send out all the major stuff that happens in the market, including these big earnings reports, Tesla, Disney. I don't know if there's a if you want to join the email newsletter, there it is. We're also going to get ready to send this newsletter out if we can. Let's get this ready. Go ahead and duplicate this one here. Yeah, I mean, the AMC traders, man, I mean, again, it is what it is. I'm not even mad at it. Like, let them do their thing. They got their own hustle. They can do whatever they want, Again, dedicating a channel around there's a lot of new rookie traders, and so there's going to be a lot of people that are interested in watching that. I mean, the funny part is, like, time's going to show that that's not going to happen. Like, time's going to show that AMC is not going to hit 140 by the end of the week. It's at 560s right now. This is just confirmation bias in its truest form. It's just confirmation bias. Is because they all want it to happen. They want AMC to hit 140 because a lot of them are just down big on it. You know what I mean? But it doesn't necessarily mean it's going to happen. And again, it's mostly confirmation bias. So it is what it is. I'm not mad. Let them do their thing. But am I going to tell people that's going to happen? Of course not, because it's just not going to happen. I'll be sitting here to say I told you so afterwards. And, they'll say I'm spreading FUD, even though the person that's saying 140 is just never going to, it's just not going to happen. Unfortunately. I'm holding a little bit of AMC. I wouldn't mind it going 140. I really wouldn't. Be a nice little bonus for me, but will it happen? Almost certainly not. I would give it maybe like less than 3%, 2% chance that ever happens by this Friday, especially maybe less than that in terms of percentage chance that actually happens. I'm feeling a little bit better, bro. A little bit better. Yeah, we'll put the expected numbers up on screen. All right, so far 53% saying put options, 47% saying call options. So that's the numbers we're getting on Twitter. 50, 53, 47. All right, we're gonna get ready to send this newsletter out. Hey, thank you, man. I appreciate it. Yeah, we're feeling a little bit better. We are feeling a little bit better. Luckily, man, it took a while, but we are feeling better. All right, so we're sending our newsletter out, the Disney earnings call. Again, join that newsletter we put above if you want newsletters sent to you on big market catalysts. We're gonna go ahead and send this out now. That looks good. That's going sent out now. Disney consolidating here. AMC down there again. Ape. We'll see. Spy. A little red today, still over 410s. So yeah, looking at the actual expectational numbers for Disney here, we can take a look. Disney expected to come in at 80 cent per share profit on 80 cent per share EPS on. What are the other expectations on 23.3 billion? Let's back up so you can see it and see the expectational numbers here. We can actually spell out revenue. Yeah, thank you, Dan. We appreciate it, man. I need some caffeine, to be honest here, man. I'm still not 100%. Hey, I need a genuine favor from those at home. You see me wearing these headphones, right? Before the earnings call starts at 4:30, like before that call starts in about an hour, remind me to switch to my AirPods because these are going to die if I wear them on a stream. All right, so what happened this morning with crude numbers? What happened this morning? Tomorrow we have jobless claims. I don't think we have anything else big. Today we've got Disney. Tomorrow, Pepsi, Hilton, VERU, PayPal in the evening, Lyft, Cloudflare, Expedia, ACB, a bunch of other ones too dropping. Disney PE, we can take a look at it. So Disney PE right now I'm showing is about 63. It's not the best right now. Yeah, we might have some little discount dips to buy. I think everything's still kind of expensive. Apple is down to 150s. Well, Disney is down to 111s. Maybe we'll buy it. I'm in Ford. Ford's actually still pretty green for me today. So Ford is kind of outperforming the market today. And I'm happy about that. Yeah, AMC lost big percentages. Bed Bath & Beyond lost big percentages today. Ford is still doing okay. MSGM is up some today, but it's still, not at anywhere near good enough levels to justify buying it, I think. Hey, what's up, Johnny? Let me get our Discord set up here. hit that like button. Again, we're a little bit early streaming, but Ford's actually doing okay, man. We bought Ford at 13.17s. It's at 13.40s right now. MSGM is up. Still got some time. Disney's scheduled to drop at 4:05, so in about 35 minutes. All right, so market almost up to 411. It's a little bit of a red day. Nothing super major or like dramatic here. We do see MSGM starting to make a move towards 17. So if you want to look at like some penny stocks or low floats that are starting to run, look at MSGM. We do have one share of this for fun, but it's still got a long way to go before we're green. Again, Ford, we bought Ford the other day. Still in it right now. So we bought Ford the other day, and it is really nicely up. We bought it right after the earnings drop. We entered it at an average price of 13.17, and so we got in basically at the bottom here. Right here, it was our entry, 13.17s, and yeah, you can kind of see where that level is way down there. So nice little green trade so far on Ford. We'll see if that turns out well for us. Aside from that, I mean, y'all got to remember CPI drops Tuesday of next week. That'll be a big thing that we should be paying attention to for sure. How did Tesla end up doing? Did Tesla end up reversing here? So Tesla's still over 200s at 201s. And we mostly made money on Tesla today. We were day trading the momentum from Tesla. Like, we didn't actually take Tesla itself, but we assumed that Tesla hitting 200 would make the market test some higher levels at the open. And that's kind of what we got. Remember, we got the full earnings call a little bit later on as well. Hey, what's up, Achilles? I'm all right, man. Yeah, Netflix. I'm wondering if there's going to be any type of sympathy with Netflix and Disney, potentially Disney Plus. Netflix is testing highs up there. It might drag the rest of the market up with it too. We'll see. Still got a little bit of time before the Disney earnings. Got over 100 people here, so hey, hit that subscribe button. Again, we are pushing towards 100,000. So we are pushing towards 100,000. If we have a good stream today, then we might hit it. But we got jobless claims tomorrow, so it'll be a potential run for 100K. The Turkish government restricted Twitter all across the country. All right, so getting some run-ups here. You see Disney starting to move all the way up to almost 111.50s here. It's just under the volume-weighted average price. Netflix sets new password sharing guidelines. Yeah, I saw that, man. Again, I don't know how good of an idea that is. I think people are going to buy Netflix regardless of whether they share passwords. I just can't imagine that password sharing is like some huge problem with Netflix. Like, are they losing money? Sure. Is it large enough to do full-on like press releases about password sharing restrictions and coming out like that during earnings reports? I don't necessarily think so. I think they're dropping the ball a little bit doing that. I think they could just restrict it and not say anything about it. Like the people who are sharing it can't really say, hey, Netflix stopped letting us steal from them. Like, why make a press announcement from it? Just leave it alone. Just do it and don't say anything about it. Disney will affect the market. It'll affect it some. Disney's starting to run up right now. So Disney's starting to run up right now. So look at Disney pump here at 112s. Starting to move a little bit. What else moved today? I see the market was somewhat red. I see Disney starting to creep up some. No news is necessarily out right now, but Disney just broke green on the day. Market's down at 411. Not a huge percentage. Yeah, GOOG's down. Yeah, for sure. Basically, they came out with the competition with Bing is the fear, I think, for this is what everybody's worried about. Yeah, good enough. Sounds interesting, man. We'll see. Burry predicted 15 of the last 2 recessions. Sounds like the YouTubers. All right, so Disney over the previous closing price. I'm going to look to see if we have any news regarding Disney. We got the Super Bowl. What is the Super Bowl? So Sunday, this Sunday. Yeah, but Disney popped up. Spy is trying here. Disney will be 130 after earnings. No, it won't. No offense, man. It's just not going to be that, bro. Yeah, it's just not going to be that. I wish it was, but it's just not, All right, so Disney broke all the way over the previous closing price, pulling back down to 111.60s now, back down to 111.60s. Again, we'll see if we do anything, but it's getting up there, trying to hold that green level here. So you see Disney's actually testing that red to green, green to red level. Let's take a look at Disney's EPS history. This is what I've been doing each stream, and I think this is, generally pretty helpful. You can kind of see Disney here. If we look at this, Disney, they've been profitable for the most part, but they are scheduled to take a little bit of dip, or they are shooting for a little bit higher EPS than they've had. And let's see. So if they hit their EPS target, so if they're on par with expectations here for Disney, it will be the highest EPS Disney has done since 2019. So the last high, so 80 cents is what's expected quarterly, first quarter earnings results, right? So that's what's expected here is 80 cents a share. 80 cents a share. Now, what you can see here is that the last time Disney had over that, every other time prior to that has been less. Last time Disney had over that was, again, June of 2019. June of 2019. Or no, I'm sorry, December of 2019. December of 2019, we had beat that. So, if we come in as expected with Disney, it'll be the highest EPS we've had since 2019. Now, I'm not saying that's going to happen here. We can look at the actual PE ratio after they drop it. But that's basically what we're looking at. We also have Robinhood scheduled to release their earnings today. And Robinhood is just kind of, nobody likes Robinhood anymore, man. Nobody likes Robinhood. We also have Affirm, AFRM. Pretty red day in that regard for this one as well. So we do have a lot of these coming out today. Some relatively well-known stocks coming out today, but nothing big. Yeah, that's probably right, boss man. That's probably right. I don't mind it dropping big, and I can scoop it up cheap, 100%. I'm okay with that. Last time Disney had bad earnings, I bought 2-month calls, and they paid off big time. Yeah, man. I mean, I might look for some options, too. Not today, though. That's the thing. Like, taking earnings right now is essentially a gamble because you're not going to be able to buy or sell earnings in after hours. You can only buy them during market hours. So you effectively have to basically take a gamble on what the earnings report is going to be. And I just don't know if I'm willing to do that yet, And again, we'll see, but, Didn't Uber drop their earnings this morning, right? What did Uber post? Uber posted Uber posted 29-cent profit, beat 21-cent loss estimates. Disney's volatile right now, though. Look at Disney; it's moving fast, man. So it's volatile right now. So it's volatile. Oh no, I bought calls the day after they were cheap. Yeah, I mean, if Disney gets destroyed here, I might do the same. If Disney just get absolutely obliterated here, we might do the same. Yeah, we do a lot of these earnings calls. It doesn't look like Disney's like a big one, I mean, I'm sure we're going to get some people that show up before the actual drop here, but it just doesn't look like Disney's like a necessarily big release that everybody's weighing on. Disney, S&P 500. Yeah, Disney. Disney's number 29 on the S&P 500 in terms of weight. Yeah, Disney's number 30 or number 29 in terms of weight on the S&P 500. So Disney only makes up about 60%. Or no, I'm sorry, that's wildly wrong. About 0.6%. Let me rephrase that. 60% would be massive. 0.6%, a little bit less than that actually, for Disney. So we do have Robinhood. We do have some other stuff dropping. Aside from this, we don't really have any major stuff dropping this week. We got Disney. Unfortunately, the way the market kind of works is we'll get a slow week and then we'll get a busy week and then a slow week and then a busy week. This is a slow week. Next week will be a busy week. Nvidia drops theirs. And aside from that, like, we just don't have anything big coming out this week, man. Yeah, Apple below 150 will gap down. SPY down 408 will gap down. Maybe Peter. I mean, y'all have to understand my bias at this point is on the upside. Mostly just because I got so many people in here telling me the market's going to crash every day, and then it never does. And then they sit and then they scream manipulation and cry about it when it doesn't. It's just constant. Like, I just see it constantly. Michael Burry in a similar boat there with everybody else. All right, guys. So yeah, Disney up to 111.50s here, 111.50s. We got afrm dropping their numbers as well. We got Robinhood. Anyway, Robinhood is at 1040s right now, 1040s. They're expecting 13-cent loss per share, so not profitable yet on about 400 million, 397.1 million in revenue. Afrm is expecting $1 per share loss on 416 million. So that's just not a good margin for Afrm, man. Afrm is just not doing the hottest right now. If you look at Afrm longer term here, Afrm's had a rough chart. Robinhood, it's been a little bit better, mostly neutral, but slightly down. We also have APPS, Digital Turbine, coming out today. They've got a rough looking longer term chart too. Yeah, we'll see. Just bought some Ford calls. Yeah, I bought Ford a few days ago. Like I said, I bought Ford right after this big earnings drop, right? So Ford, we bought Ford here. So we bought Ford like right here. Like right here is where we bought Ford. And it looked, in hindsight, it was a good buy. It was a good buy. Ford has gone up, pretty decent percentages overall since then. Thoughts on Robinhood? To be honest, I'm not super confident in Robinhood. I'm just not. The reason I'm not confident in them is because they used to have the young traders vote. Like new traders, young traders would use them. They were easy to use. They had their niche carved out with mostly new traders, right? Once the trader becomes experienced, they generally stop using Robinhood and move on to more higher ceiling brokers that are just easier to use, or that are not necessarily easier to use. But they have more capabilities, higher capability brokers. That's generally what happens, right? Over time, that's kind of what happens. The problem with Robinhood is that they burnt their bridges with the AMC community, which is a lot of young traders. They restricted stocks that were squeezing up, that was essentially hurting big banks. And so Robinhood looks like they got the big banks in their pocket over the last few years. And I think that's going to discourage people from using them. It's definitely made the price and confidence drop. I used to be very confident in Robinhood before that happened. I was very confident in Robinhood. At this point in time, I can't say I'm super confident in them. I just can't. I used to think it was like you got to understand there's a big difference with Robinhood today than there was from 4 years ago. 4 years ago, Robinhood was the platform. It was the broker. Everybody was using them. I think Robinhood's management is just not good management, is what I truly think it is. And I'll explain why. I think one of the reasons you see Webull, Webull is a huge platform, growing like crazy, has only gotten larger and larger and larger over time, regardless of controversies that they've been caught in. Webull has gotten larger and larger and larger over time. One of the reasons Webull has done that is because of affiliate systems, right? They have a great affiliate system where you can essentially, make money referring people to Webull, right? So they've got a lot of affiliates basically referring people to Webull, and they're making money, and so they keep doing it. Robinhood has got a $500 cap on affiliates, and so no real person is going to spend their time plugging Robinhood. No real person is going to continue to plug Robinhood because there's such a small cap as an affiliate, right? So they're not getting young people, young influencers promoting them like Webull is, because there's just no money in promoting Robinhood, to be fair, right? And that's not really what it's about. But I think they only just now came up with like an advanced platform, and even still, it's got some problems too. And I think they should have come out with that platform years ago, because one of the big problems with Robinhood is the bounce rate is super high. The amount of people that use Robinhood for a little while when they're first starting to trade, and then eventually just say, all right, I'm going to move on to Thinkorswim. I'm going to move on to Schwab. I'm going to move on to one of these higher capability brokers. I'm sure that bounce rate has got to be super freaking high with Robinhood. And so I think they just make bad decisions. And I can't trust a company that makes that many bad decisions. And with that, Robinhood, I think it's just one of them. Disney started to move up to test the previous closing price. We still got about 10 minutes, guys. I'll put the timer up, but we still got about 10 minutes before the data comes out. We got about 8 minutes, actually. So we got about 8 minutes. But yeah, and again, I'm open to hearing arguments against what I just said. But overall, I think it shows me that I just don't know if their management is the right ones. I don't think they can really have a clean plan on what they're doing. I think that the CEO is probably just pocketing money and I don't know how much confidence he has in his own business. I think one of the biggest things that hurt Robinhood was all the other big brokers piled on to payment for order flow, right? They just piled on with them. So instead of using Robinhood now, you don't have to use Robinhood. You could use TD Ameritrade, you could use Webull, you could use Schwab, you could use E-Trade. None of them make you pay commissions now, and that kind of hurt Robinhood's niche. So overall, I'm just not super confident in them. I think the one good thing Robinhood has is their options trading interface. The interface in the AI or in the UI for options is great. I like using it for options, but aside from that, I don't know if that's a big enough window. What, buddy? Here, no, I can't right now, bro. Because the cords are on that and it might disconnect it, buddy. I'm sorry. Okay, I can't right now. Look, I love you, but I can't right now. All right, go lay down. All right, my son's home sick from school. But yeah, guys, so we got a couple minutes now. Disney is shooting up right now, shooting up. We also put it in sub only mode. So if you haven't already, hit that subscribe button, guys. Help us get to 100K. We're pretty close. I think if I wasn't so close to hitting 100K, I don't know if I would actually stream Robinhood earnings, to be honest. Like, I just don't know if I would actually stream them. All right, guys, we got 10 seconds before we got some of these big earnings coming out. Robinhood is actually scheduled here. None of these are really scheduled to drop at 4 on the dot. We got Wynn scheduled, WYNN. They are scheduled to drop right at 4. We'll see how they move. Here's Wynn. Most of these drop in 5 minutes, though. We're gonna switch this. So we got this timer up. We got about 4.5 minutes left. We got Disney up to almost 112s right now. Again, we got Wynn dropping. We're supposed to have afrm. We're supposed to have Robinhood come out with their numbers. We got APPS dropping theirs. Expectations are 37 cents a share. Kraken does. Isn't it mostly crypto broker or? Yeah. All right, Disney's still creeping up here. We still got about 4 minutes before the numbers drop. Again, if you haven't already, hit that subscribe button. We're so close. We're less than 400 subs away from hitting 100K. Again, I'd love to hit it this week. It'll be close. I'd love to hit it this week. We'll see, but it'll be close. Regardless, so there's APPS popping up. I'm sure some other stuff is going to come out with their results here too. Looking at afrm right now. Nothing for afrm. Robinhood. Nothing for Robinhood. APPS, nothing yet. We still got about 3 minutes here, team. Down 20% on Disney. Are you shorting it? Why would you ever short Disney though? Like, people get politics mixed up with stock trading. Like, y'all might disagree with them politically, but like, Disney owns Star Wars, Marvel, ESPN. Disney World makes so much money, bro. Plus is growing by huge numbers. Like, why would you ever short Disney? Like I said, people get their trades, they get them too involved with their political stances and whatever it is, right? But in the end, none of that matters, right? I'm looking at Disney as a potential money maker, and Disney is just super volatile. So there's big volatility rolling through. Disney makes so much money, man. All right, Disney faces mounting pressure from an activist investor. I see a Disney move here. I don't actually see the earnings report out for them, though. They are moving very volatilely. Here's APPS. Nothing yet. Robinhood up to almost 11s here. Is the SPY moving up? What's going on? No, not really. All right, still waiting here. Tesla closed over 200 today, though. That's impressive. We got Robinhood trying to make moves. Yeah, and maybe Qualis, maybe, bro. I don't know. I'm not really going to speak on things that I have no idea about, right? But even if that was the case, like, trying to be a moral trader is usually a losing endeavor. All right, like, trying to be a moral trader is usually a losing endeavor, right? You saw it with AMC and GameStop, right? Where GameStop was pushing up to 550s. And everybody was like, hey, should we sell? Should we sell? And everybody was like, no, don't sell. Hold the line. Don't sell. Let's be moral traders. How did that work out for that crew? Disney is super strong financially. Again, if we look at GameStop dropped, what, 75% from where they were at that point in time? AMC, same thing. Like, y'all, again, being a moral trader, like, if you want to do it, that's cool. But again, stock market and morals, it doesn't really mesh well to me, bro. Yeah, YWNN dropped their earnings here, up to 105 for Win. So Win posted 29-cent profit EPS, or Win missed 123. All right, so there we go. Let's look at Disney. Disney with a big drop down here. Big drop for Disney. Let's see what the numbers actually show up as. Big retracement all the way back up to 112. A lot of volatility come through for Disney. We're waiting for the numbers to actually come out here. Bear with us. We are waiting for the numbers to actually drop here. But Disney is ripping up big, up to 114s for Disney, guys. 114s. Wow. Okay, so Disney posts 99-cent profit, beat the 78-cent estimate. It's the best performing EPS ratio since 2019. Sales beat expectations as well at 23.51 versus 23.37 here. We'll still put these numbers in chat, but Disney beat both metrics here for earnings. There's the numbers right there. Again, Disney did much better than expected. 99-cent EPS on versus 78 or 80-cent estimate is what I had on my end. Robinhood came out with their data as well. Robinhood's net loss was 166 million, EPS of -19 for Robinhood. And Robinhood actually is reacting pretty positively to this. Robinhood's up to 1120s right now, 1120s. But Disney flying up, man. Again, beat on EPS, beat on sales revenue. Exactly what I was just saying here, guys. You don't bet against it, man. Like, they make so much money, bro. Like, you can't, like, it clouds your judgment. It is the big thing to understand, is that it simply clouds your judgment, man. And I've been saying this, to be fair. I've been saying this before Disney was this strong. I've been saying this since Disney was at $85. Ask any of the haters that hated those trades and called me a clown. I've been saying this since $85 a share for Disney a month and a half ago, right? And now Disney's up to 115, and we were wildly correct on it. Disney's a money-making machine, man. They own Star Wars, Marvel, ESPN. Disney World makes $20 million a day. Okay, I'm not going to bet against a company like that. This is the best performing EPS for Disney, and 3 years since 2019. And again, we'll see if it holds. It doesn't necessarily mean anything yet. Disney has had a huge bull run. If you look at a 20-day chart for Disney right now, here's a 20-day chart for Disney. Look how big that thing is, man. Hold on. Buddy, I'm working, man. What is it? I can't get you paper, bro. I can't. It might disconnect my computer, buddy. I'm sorry. Hey, I'm working right now. Look, I love you. Here, go ask your mom. I'm working right now. I can't do it. Okay, I love you, buddy. I'm sorry, man. Sorry, but the cord is like right underneath me, and he wants paper out of the box. And if I do it, it could unplug it. So I'm just gonna. He's got to wait for a piece of paper. All right, so Disney with a big pullback here, down to 113s. Robinhood completely turned red on the day. Here's the Robinhood numbers. All right, so yeah, Robinhood, the co-founders, and maybe they're making some better decisions here. Robinhood co-founders cancel nearly $500 million of their share-based compensation. Yeah, you got Robinhood numbers here. And Disney could turn red. I think Disney might be the reason I didn't buy up Disney now. And I don't mind it dropping because, like I said, if it drops too much, I really will buy this up. I'm not saying I'm going to, but like this is too high for me. Like a trend that looks like this is too expensive for me right now. You know, like look at this trend. You know, like I need it down to like here, personally myself. And again, let me know what you guys think about this. Really kind of choppy though. I mean, it's going back and forth. It's going up and down and up and down, up and down. A lot of down wicks, pressure. Robinhood kind of the same way. Somebody asked me to cover APPS, and look, we'll cover it. It's all the way down to 13s here. Digital turbine. We'll put the digital turbine numbers in chat. I don't know, Bjorn. I really don't know, brother. I really don't know, man. Again, I don't like saying anything like that. Like, I'll tell you guys if I take any positions in it. I need Disney to drop down to at least 100, I would say. For me personally. Again, I'm not an investment professional. I have no idea what Disney's going to do. I need it down to at least 100. You know, generally, I don't like buying Disney until it gets down to like 92, 91. It is when I usually start. The last time I bought Disney, I started buying it at like 90s, low 90s. And high 80s. That was kind of my sweet spot, low 90s, high 80s. Affirm numbers are out as well. Affirm is reacting very negatively here too. Again, Affirm posted 110 loss per share in EPS on 98-cent estimate. Sales of almost 400 million, 399.56 versus 416 estimates. There's the Affirm numbers in chat. Again, hit that subscribe button, guys. We've got about 600 people here. Hitting the subscribe button right now can really get us pretty close to hitting 100,000 this week. We need about 350 subs to get 100K this week, and that's certainly possible if we get 1 or 200 today. And so, listen, if you're not subbed yet, everything we do here is free. It really is all love here. Like we don't claim to be an expert. I don't sell a course. I don't act like a guru. I just put everything out there for free. I try to give people the honest truth, even if it hurts my growth or whatever it is. And we cover all the major data, CPI, PPI, Jerome Powell press conferences, jobless claims every week, non-farm payroll data. We stream all the big earnings reports like Disney, Apple, Tesla, Netflix, so forth and so on. So, hey, hit that sub button, guys. Help us get there. We're getting close. All right, so yeah, Disney bouncing right at that previous closing price, still moving up. In terms of earnings reactions here, Robinhood has started to push up too, kind of trending similar to Disney in terms of just market reactions to earnings here. Robinhood is starting to get close. Disney all the way back up to 114s here. If we're looking at the broad market hasn't really moved much. We're sitting just under 411s at 410.50s right now for the SPY. So the SPY is mostly a neutral trend since this. Remember, the earnings call starts. In about 20 minutes. The earnings call starts soon. We're going to switch the timer out. We got about 20 minutes before this thing starts. So yeah, we got about 18 and a half minutes, we'll call this. All right, so we got this rolling here. Here's the timer until the actual earnings call starts. Disney's starting to creep up, testing that 114 level here for Disney. Right at it now. Let's see if it can break. Right at 114s. Disney's ranked about number 3 or number 30. I mean, about number 29. Yeah, I get it, Daniel. But to be fair, man, like you've been mostly bearish, and that's fine. Like you could be bearish, but like you're just a random member of the chat. You know what I mean? Like for me, who runs this channel and hosting these live streams, it's very important for me to do my best to stay neutral because again, something that influenced me in the beginning was I'd have doomsday YouTubers saying, hey, the market's going to crash. The market's going to crash. Like Burry has tried to predict 15 crashes and it's only been right about 2. You know, like I don't think doomsday tubers are necessarily healthy. I think they influence people's positions too much and people miss out on growth and gains from it. So for me personally, generally I'm a bull. I generally would prefer the market to move up. I make most of my money on the long side. But I also understand that we do approach extended levels. Like for Disney right now, I think we're a little extended on the upside. I'm not going to buy it right here. It's just too high. I prefer to look for big drops and then scoop those up at discounts and then hold on to those. That's my trading style. But with regards to like telling people, hey, this is what's going to happen or this is what's going to happen, I just have to avoid that. That's not really what I'm about. I don't want to act like an expert or a guru. I would just prefer to report on what the news actually was, report on what the data actually was, and not tell anybody, hey, I think Disney's going to do this or that or this or that. I think earnings reports are mostly coin flips, right? And I think a lot of young people gamble on earnings. And just gambles, like they flip a coin is essentially what they're doing by taking big positions ahead of this. Nobody really knows what's going to happen, and I would rather just not hurt traders in that way, But again, you're in the chat, and so of course, you're welcome to give your bias, and it's all love here, man. It really is. It's all good. I've been kind of trolling the bears a little bit the last couple of days, but like I said, they might be right, man. Maybe the market crashes. I genuinely don't know. Hey, thank you, Mo. I appreciate you, brother. Thank you, man. Yeah, every time Disney drops down to the low 90s, high 80s, again, I'm a broken record, bro. I talked about it the last time too. I had a lot of haters mad that I was making that I told people I was buying Disney and that I thought Disney was cheap at those levels, and I turned out to be very right. Nobody can deny that. I think anybody that watches this stream knows. But Disney's just not there yet for me right now. It looks strong right now, though. It's reacting really positively here. It's the best performing EPS and numbers since 2019. And so these numbers are pretty solid for Disney. I mean, the EPS well above expectations, almost to $1 per share. Hey, thank you, Joe. Yeah, but I don't really want people to copy me, though, Daniel, is the thing, bro. Like, I just don't want people to copy me, man. I'd rather people just not copy me, so... I give people the logic behind it, why I think Disney long-term is a profitable company. Diversified super well, own ESPN, Marvel, Star Wars. They generally perform well with regards to earnings and EPS and revenue. Prior to this latest run, their PE ratio was relatively low. They own Star Wars, Marvel. They're diversified in media. They've been around for over a century. I just think there's a lot of arguments for Disney long-term strength. Short-term, again, they're a little bit too high for me personally, but again, it's all, it's all preference and, analyzing it is subjective. Some people are going to like it, dislike it. It's all good either way. But I like Disney. And I've been saying this since 85, Hey, nice, Jason. Hey, thank you, Ray. I appreciate you, man. Thank you, sir. Yeah, when I bought Disney last time, I'll say this, right? When I bought Disney last time, I had a lot of people that said, oh, I don't like Disney here. I say, hey, I'm buying it at low 90s, high 80s, and I told them I'm in a position. It was a pretty big position too. And I said this, and people said, "Oh no, Disney. I'm not buying Disney. I think you're going to lose money. I think Disney's about to crash." They'd say, "I think Disney's going to hit 50," is what they said. And this was only a month and a half ago. And then in hindsight, Disney ended up ripping up from my low 90s, high 80s entry prices all the way up to 115 basically, which is where we're at now. And so, like I said, I have a unique perspective. I hear both arguments a lot, and I've learned to tune them out because most of the time, my own intuition is correct. And I'm like, hey, this is cheap here. I'm going to buy it. Again, I did it with Ford a few days ago. I had people telling me not to buy Ford. Ford is now up about 40 cents a share on my Ford position. We bought it at the very bottom, essentially, for Ford. That turned out really well. Same thing with Snapchat. Snapchat, we bought it a couple days ago at $9.99. To a lot of people arguing against the buy. One person even said, what are you thinking? And ended up pushing up over 20% over the next week. And so again, I just got to go by my own intuition. I've learned that over time. I've been watching charts and stocks long enough to where I like my intuition, No, it's all good, Daniel. Again, though, like I said, man, I think there's enough people out there trying to give stock market picks that I don't need to. I would rather not do that. There's too much pressure. Again, if I would have listened to all the people giving me picks in my room, especially short predictions over Disney or Ford or Snapchat, I would not have had most of the profitable trades that I've been in over the last couple, months. And so I think I'd prefer to run my channel not pressuring people to do things. And, in the end, I really don't know what Disney's going to do. I'm a long-term bull in it. And, it's a little bit too high for me up here. Yeah, Nibbles, and I understand that logic. But again, I talked to Bears about this yesterday, and it's all love here, it really is. But, like, I'm pretty flat in everything. Like, I'm not really holding anything right now that's going to be influenced by, like, a market crash. Like, if the market crashed, I wouldn't lose much at all right now. And really, I'm waiting for a pullback. I wouldn't mind it, a correction right now because it'd give me some discounts to buy up. All right. Hey, will you bring me like some caffeine of some sort?
I really gotta go. Like, I gotta go.
All right.
I mean, I could pour you some of the coffee that I just made.
It's got sugar and stuff in it.
Put creamer in it, yeah.
Creamer or sugar?
Creamer. Well, it's got creamer. That's sweet.
Yeah, I'm all right.
I mean,
can you bring me what? Just a Coke.
I can see if we have one. I just gotta get going.
All right, we do. Yeah, I'm just trying to be the most responsible I can. Again, I feel like if I was like, yeah, the market, here's the problem. Okay. Like with everybody saying the market crashes, right? And again, I'm going to preface this with like, I really don't know. Like, I don't know if the market's going to crash. I don't know if the market's not going to crash either. But when you look at the SPY and you zoom out, the SPY has been red for the last year straight. So we're on a down year anyway. Most crashes happen when there's a peak, and then a boom crash, right? That's not really what we got right now. Like right now, we're actually down on the year. We're essentially what happened is like in 2020, the pandemic started, and that negatively affected everything with regards to shipping and supply and freight and stuff like that. Over time, those things are starting to get better, and hopefully they continue to get better. Right. But that's ultimately what caused the inflation that we're experiencing right now is shipping problems, freight, shipping, supply. Those type of problems have caused this inflation that we're experiencing right now. But those inflationary, metrics are getting better. They're getting lower each time. CPI, PPI, PCE, they're all generally getting lower over the last couple months. And so we could crash. Like it's possible we do. But I think there's also an argument for us not. And for those that act like it's just an absolute for sure thing, we're going to crash. Again, I think that's irresponsible. And I see it. I know a lot of YouTubers are saying, oh, the crash is happening. It's going to start now. They've been saying that every video for like 3 years. At a certain point, it's like, all right, we're going to crash. Okay. I'm not a man child. I've just got a wife, bro. I'm married, You think that's my mom? Nah, bro. That's my wife, dude. My little son has been running in here trying to get stuff. I'm working right now. So yeah, she brought me some caffeine. You better believe I'm going to ask her to bring me some caffeine if she can. She could have said no. You know, I wouldn't have been mad at her if she did. It doesn't mean much. Don't hate. All right, Q. My guy just lost a bunch of money, and he's mad about it, Q. Good day to you, sir. Dividend investing? Maybe, man. When my portfolio gets much bigger, maybe, bro. To really make money dividend investing, you need, like, reasonably, you need, like, 500K a mil in your portfolio. I don't quite have that yet. Maybe, though. You know? Yeah, PayPal tomorrow, I believe, right? PayPal's tomorrow. I can try covering PayPal. I've never streamed PayPal earnings, but maybe we get some stuff. My guy Q had a bunch of puts on Disney, and now he's just lashing out at chat. Let it out, Q. It's all right, man. Listen. Yeah, you need at least $1 million to really genuinely live off of it. You know, like if I won the lottery for like 5 mil, I'd take 20% of that, like $1 million, and I'd stick it into dividend stocks, and I'd live off of that. And then I'd probably take another $1 million and put it towards whatever, you know. Firm? How's the firm doing, man? The last time I looked at it, it was down, and it's even down more. Yeah. A firm is one of those companies where they're not bad, but man, look at Disney pump up over 115s. It's a big move here. So we will stream the earnings call. The earnings call starts in about 7 minutes. 7 minutes. All right, guys. So Disney over 115. A firm is cutting 19% of the workforce, expects to incur 35 to 39 million in restructuring costs. They're going to lay off 19% of their staff. They see third quarter guidance at 360 to 380 million for revenue versus 417, so lower than expected revenue guidance for the third quarter for a firm. Fiscal year 23 guidance for a firm came in light at 1.475 to 1.55 billion versus 1.64 billion estimates here. So yeah, a firm coming in light on guidance and just having a really bad earnings report. Disney about to break highs here. And again, this is exactly what I'm saying, man. You know, again, Disney popping up big here, popping up big. We'll see if it continues. Are you streaming the live? Yeah, we're going to stream the call for sure. 3 properties, house hack 1, meaning you buy a duplex, get an FHA loan for the duplex, live in half of it, and charge. Yeah, there's a few ways you could house hack it. You could get an FHA loan with 3.5% interest rates, and then you could buy a duplex with that, live in one side of it for at least a year, rent out the other side, have it pay your mortgage on that. Or you could just buy a house, you know, rent out the rooms and be the landlord there and have it maybe make a little bit net in cash flow every month. There's a few different ways you could do it. I wouldn't recommend the last option. That's going to be really tough to do and just uncomfortable and not fun, you know. But the duplex option where you get one side, you know, a tenant that pays you, gets the other side and basically pays your mortgage down. That's a good option for sure. If you can find a good one, you know. Yeah, bro, I was buying up stuff when the C word happened, dude. And again, I was telling everybody, making videos about buying up stuff when it happened too, bro. Like, I remember I bought United Airlines, I bought MGM, I bought up all these stocks, and everybody hated on me. Everybody, again, it was very similar, to be completely honest, right after that started, when the market tanked, right? When, again, if you look at United Airlines, right after it, when it happened, when the market tanked, when United Airlines, let me put up a weekly chart here. Like when this happened right here, when this happened right around February of 2020, like right when it started, very similar dynamic where we had these big drops, and like it was exactly the same here. Right here, everybody's saying, hey, the market's going to crash. Oh, it's just starting. Oh, the fire's just starting. Oh, the market's so red. You know, oh, this is just a temporary bounce and the crash is coming, right? Very similar to right now, which is right. Y'all got to understand my experience influences my bias here, right? Oh, the market's going to crash. Oh, the market's going to crash. You zoom out and you can kind of see like, hey, the market eventually bounced all the way back. Same thing here, right? Same thing. Where is it at? Same thing here, I guess I should say. Doom and gloom, market's going to crash. It's never going to come back. And then it ended up ripping back up. And again, I'm not saying maybe we crash. Maybe this is the time they're right. But it doesn't have to be. And it's not a for sure thing at all. Again, hit that sub button, guys. We need less than 350 subs right now. Less than 350. We're so close. Yeah, I can understand that. Maybe the housing market corrects some. I can understand that possibility for sure. It could happen. You know, it might happen. Again, I do think there's a bubble in the housing market. But it might just kind of slowly come back down instead of crash, you know. Disney right around 115s. Yeah, I don't mind the market crashing either, to be honest here, because again, I'm not really in any blue chips right now like that. Holding Ford, I don't know if you consider that a blue chip. I think you probably can just for its notoriety. But I'm not in anything else like that, you know. And so I wouldn't mind a big correction where I could just scoop up some cheap stocks. Again, everybody always thinks it's going to happen. Like, again, the question you have to understand here is that, like, even if we do crash, right? Hold on, let me get the earnings call ready here. The earnings call is about to start pretty soon. All right. We are ready. We are on hold, ready and waiting here. Should begin anytime soon. Still pumping up, almost to 116s here. Almost to 116s. Looking at our Twitter account, let's see what the votes were on Twitter. We got about 100 votes, 56% call options, 44% put options. All right, so there's 430. Still on hold. Can y'all hear the music? I just turned it off, but prior to this, you should be able to see it. Like you did with Snap, would you consider a firm? No. The reason for it is that I don't know a firm as well as I know Snap. Snap's got tons of daily active users. I don't know a firm like that. I think a firm is a little bit more obscure than Snapchat with regards to their overall business, name brand, products, and everything else, right? Whatever they and so because of that, I'm just not as confident in doing it. I'm not as confident in doing it in a firm that I would be a Snap. You know, basically, I have more confidence Snapchat's still going to be widely used in 5 years over a firm. All right, market's starting to trend up, almost to 411s here, almost to 411s. Oh, thank you, my guy Nate. Hey, coming through. Thank you so much, man. That's actually a big help, bro. Stream could have cut out midstream if it wasn't for that. So bear with me. We're in there. Still on hold. Disney earnings call still hasn't started yet. Let's get this up. Yeah, but a lot of those were mid caps, Derek. Name some blue chips that had that happen, brother. And from their all-time highs, it's just a different story. Stocks don't always break highs and continue moving up. So So it really depends on, what stocks it is. Mid caps lost a lot of value, but that doesn't mean anything. Like you can see Peloton, tons of value lost. BYND, tons of value lost. That doesn't necessarily mean they're cheap right now because, again, a lot of businesses got big and then lost a lot of, interest after. So it's like it depends on which blue chips you're talking about. All right, guys. So again, we are sitting here waiting. Earnings call still hasn't started yet. It's supposed to start right now, but no, not yet. I'm going to refresh it just to make sure we're not missing this. Man, they got some hold music up. Um, no, I sold Snap. I sold Snap at like $12 or something like that a couple days ago. Not yesterday. I think the day before yesterday I sold it. So yeah, I'm out of Snap. Like I said, it was a swing trade. I made big percentages quickly, and so I took profit. You know. Again, y'all hit that sub button, guys. I see we almost got 600 people here. I would really love to hit 100K this week. They got some super cinematic music playing. Yeah, Meta was for sure, right? But Meta at this point has already made its rebound, like Meta's already bounced back. And so it's like I would prefer to buy these companies down here relative to up here. All right. Sound check.
Investor Relations section.
Sound check. Let me know the sound is. Hit the subscribe button. Oh, they do. They faked us out. They said, oh, do this. Okay, here we go.
Good day, and
Sound check.
welcome to the Walt Disney Company's first quarter 2023 financial results conference call. All participants will be in listen-only mode. Should you need assistance, please signal a conference specialist by pressing the star key followed by 0. After today's presentation, there will be an opportunity to ask questions. To ask a question, you may press star then 1 on your touchtone phone. To withdraw your question, please press star then 2. Please note, today's event is being recorded. I would now like to turn the conference over to Alexia Quajani, Senior Vice President of Investor Relations. Please go ahead.
Good afternoon. It's my pleasure to welcome everybody to the Walt Disney Company's first quarter 2023 earnings call. Our press release was issued about 25 minutes ago and is available on our website at www.disney.com/investors. Today's call is being webcast, and a replay and transcript will also be made available on our website. Joining me for today's call are Bob Iger, Disney's Chief Executive Officer, and Christine McCarthy, Senior Executive Vice President and Chief Financial Officer. Following comments from Bob and Christine, we will be happy to take some of your questions. We have a lot to get through today, but we'll do our best to answer as many questions as we can. So with that, let me turn the call over to Bob to get started.
Thank you, Alexia, and good afternoon, everyone. It's an extraordinary privilege to lead this remarkable company again, especially at this special moment in its history as we celebrate our centenary. Since I first became CEO in 2005, I have guided the Walt Disney Company through 2 significant transformations. The first was to confer greater creative control and authority to our creative businesses and to focus on great brands and franchises. It was also aimed at embracing new technologies and expanding internationally. It ultimately led to the acquisitions of Pixar, Marvel, and Lucasfilm. Second transformation took place beginning in 2016, when we laid the foundation for Disney to become a true digital company. As we were planning to launch our streaming platforms, the opportunity arose to acquire numerous assets from 21st Century Fox. And that acquisition gave us a bigger library with more franchises, a broader global reach, and a talented, experienced management team that enabled us to generate even more higher quality content. In 2019, Disney Plus launched with nearly 500 films and 7,500 episodes of television from across the world of Disney. 3 years later, its meteoric rise is considered one of the most successful rollouts in the history of the media business. Now it's time for another transformation, one that rationalizes our enviable streaming business and puts it on a path to sustained growth and profitability, while also reducing expenses to improve margins and returns, and better positioning us to weather future disruption, increased competition, and global economic challenges. We must also return creativity to the center of the company, increase accountability, improve results, and ensure the quality of our content and experiences. Now the details. Our company is fueled by storytelling and creativity, and virtually every dollar we earn, every transaction, every interaction with our consumers emanates from something creative. I've always believed that the best way to spur great creativity is to make sure the people who are managing the creative processes feel empowered. Therefore, our new structure is aimed at returning greater authority to our creative leaders and making them accountable for how their content performs financially. Our former structure severed that link, and it must be restored. Moving forward, our creative teams will determine what content we're making, how it is distributed and monetized, and how it gets marketed. Managing costs, maximizing revenue, and driving growth from the content being produced will be their responsibility. Under our strategic reorganization, there will be 3 core business segments: Disney Entertainment, ESPN, and Disney Parks, Experiences, and Products. Alan Bergman and Dana Walden will be co-chairmen of Disney Entertainment, which will include the company's full portfolio of entertainment media and content businesses globally, including streaming. Jimmy Pitaro will continue to serve as chairman of ESPN, which will include ESPN Networks, ESPN Plus, and our international sports channels. And Josh D'Amaro will continue to be chairman of Disney Parks, Experiences, and Products, which will include our theme parks, resort destinations, and cruise line, as well as Disney's consumer products, games, and publishing businesses. These organizational changes will be implemented immediately, and we will begin reporting under the new business structure by the end of the fiscal year. This reorganization will result in a more cost-effective, coordinated, and streamlined approach to our operations, and we are committed to running our businesses more efficiently, especially in a challenging economic environment. In that regard, we are targeting $5.5 billion of cost savings across the company. First, reductions to our non-content costs will total roughly $2.5 billion, not adjusted for inflation. $1 billion in savings is already underway, and Christine will provide more details. But in general, the savings will come from reductions in SG&A and other operating costs across the company. To help achieve this, we will be reducing our workforce by approximately 7,000 jobs. While this is necessary to address the challenges we're facing today, I do not make this decision lightly. I have enormous respect and appreciation for the talent and dedication of our employees worldwide, and I'm mindful of the personal impact of these changes. On the content side, we expect to deliver approximately $3 billion in savings over the next few years, excluding sports. Christine will be providing more details during the call. Turning to our streaming businesses, I'm proud of what we've been able to achieve since the launch of Disney Plus just 3 years ago. We are delivering more content with greater quality, in more ways, in more places, and to larger audiences. Like many of our peers, we will no longer be providing long-term subscriber guidance in order to move beyond an emphasis on short-term quarterly metrics, although we will provide color on relevant drivers. Instead, our priority is the enduring growth and profitability of our streaming business. Our current forecasts indicate Disney Plus will hit profitability by the end of fiscal 2024, and achieving that remains our goal. Since my return, I have drilled down into every facet of the streaming business to determine how to achieve both profitability and growth. And so with that goal in mind, We will focus even more on our core brands and franchises, which have consistently delivered higher returns. We will aggressively curate our general entertainment content. We will reassess all markets we have launched in and also determine the right balance between global and local content. We'll adjust our pricing strategy, including a full examination of our promotional strategies. We will fine-tune our advertising initiatives on all streaming platforms. We will improve our marketing, better balancing platform and program marketing, while also leveraging our legacy distribution platforms for marketing and programming. This may include greater use of legacy distribution opportunities to increase revenue and more effectively amortize content investment. And, as I said before, our new organizational structure will reestablish the direct link between content decisions and financial performance. This is one of the most important steps we can take to improve the economics of our streaming business. There's a lot to accomplish, but let me be clear. This is my number one priority. We are focused on the success of our streaming business and the return it generates for our shareholders long into the future. Before I turn this over to Christine, a few comments about the quarter. James Cameron's Avatar, The Way of Water, which was easily the most successful film of the quarter, has become the fourth biggest film of all time globally, with close to $2.2 billion earned at the box office to date. The global popularity of this film will result in the creation of more opportunities for fans to engage with the franchise, which they've been doing at Walt Disney World's Pandora, The World of Avatar, as well as in theaters globally and on Disney+, where the first film has delivered very strong numbers. And today, I'm thrilled to announce that we will be bringing an exciting Avatar experience to Disneyland. We'll be sharing more details on that very soon. Avatar represents yet another core franchise for the company, and as you've seen time and time again, we have a unique way of leveraging creative success across multiple businesses and territories and over long periods of time. Speaking of our parks, we had an outstanding quarter in Q1, while we continued our purposeful efforts to control capacity to preserve guest experience. Last month, we also announced some price adjustments at our parks. We're listening to guest feedback, and we're continuously working to improve the quality and value of their experience. We're also proud of our creative success, as we led all studios with the most Academy Award nominations, including 2 Best Picture nominations, 20th Century Studios' Avatar, The Way of Water, and Searchlight Pictures' The Banshees of Inisherin. Marvel's Black Panther: Wakanda Forever received 5 Oscar nominations, and in addition to an $840 million run at the box office, it launched on Disney+ last week, and it has quickly become one of the most successful Marvel films on the platform. Looking ahead, we're excited about our fantastic lineup of new films coming to theaters this year, starting with next week's release of Marvel's Ant-Man and the Wasp: Quantumania, followed by other highly anticipated theatrical titles, including The Little Mermaid, Guardians of the Galaxy Volume 3, Pixar's Elemental, Indiana Jones and the Dial of Destiny, and Disney's Haunted Mansion. Lucasfilm's The Mandalorian, the series that started it all for Disney+, will be back at the beginning of March for its highly anticipated 3rd season. And today, I'm so pleased to announce that we have sequels in the works from our animation studios to some of our most popular franchises: Toy Story, Frozen, and Zootopia. We'll have more to share about these productions soon, but this is a great example of how we're leaning into our unrivaled brands and franchises. The Walt Disney Company also won more Golden Globes than any other entertainment company this year, a total of 9, including for Abbott Elementary, the first broadcast show to win a Golden Globe for Best Series in nearly a decade. Without question, we have a world-class television business that fuels both our linear channels and direct-to-consumer services, especially with the assets acquired through the Fox transaction. It goes without saying that the best shows lead to the most lucrative library and have the power to endure because of their quality. The Simpsons illustrates this perfectly. Disney Plus launched back in 2019 with more than 30 seasons, and it remains one of our top performers today. Across the board, our television business is second to none, and that includes ABC News, which remains America's #1 news network. The power of ESPN brand also continues to deliver for us. In calendar 22, ESPN linear ratings were up 8% overall and 14% in prime time, and we are also growing rapidly across our digital platforms. We're being selective in our rights renewals and continue to approach rights acquisition with discipline and a focus on supporting both sides of ESPN's business, traditional linear and ESPN is more than just a network, and today the team is harnessing innovative technology to deliver spectacular coverage and entertainment to audiences who have a deep connection to the brand and content. Now, when it comes to investing in growth and returning capital to shareholders, we will take a balanced and disciplined approach, as we did throughout my previous tenure as CEO, when we invested in our core businesses and acquired new ones, bought back stock, and paid a dividend to our shareholders. As a result of the impact of the COVID pandemic, we made the decision to suspend the dividend in the spring of 2020. Now that the pandemic's impacts to our business are largely behind us, we intend to ask the board to approve the reinstatement of a dividend by the end of the calendar year. Our cost-cutting initiatives will make this possible, and while initially it will be a modest dividend, we hope to build upon it over time. Christine will provide more information on that. And finally, on the topic of succession, the board recently established a dedicated succession planning committee. The committee is chaired by Mark Parker, who will become chairman of the Walt Disney Company's board following our annual meeting. I'm excited to work with him in his new capacity, and I'm grateful to our outgoing board chairman, Susan Arnold, for her 15 years of tremendous service. Obviously, there's a lot going on, but as I said before, I'm truly excited to be back and to lead this great company through this necessary transformation. I'm grateful for our incredible talent and my exceptional leadership team, and with that, I will turn things over to Christine.
Thank you, Bob. It's great to have you back on these calls. And good afternoon, everyone. Excluding certain items, our company's diluted earnings per share for the first fiscal quarter of 2023 was 99 cents, a decrease of 7 cents versus the prior year, as continued strength at our parks, experiences, and products business was more than offset by a year-over-year decline at our media, entertainment, and distribution segment. You heard earlier that we are embarking on a significant company-wide cost reduction plan that we expect will reduce annualized non-content related expenses by roughly $2.5 billion, not including inflation. In general, we anticipate these reductions will be comprised of approximately 50% marketing, 30% labor, and 20% technology, procurement, and other expenses. Around $1 billion of this target was included in the guidance we gave last quarter, that fiscal 2023 segment operating income should grow in the high single-digit percentage range, which is still our current expectation. The bulk of the efficiencies we are realizing this year are related to reductions in marketing and headcount at DMED. The remaining portion of the target represents incremental SG&A and other operating expense savings, which will fully materialize by the end of fiscal 2024. Longer term, we also expect to realize additional efficiencies in our content spending, with an annualized savings target of approximately $3 billion of future spending outside of sports. We will share additional details with you as we move forward on realizing these efficiencies. Bob also gave you some details earlier on the company's reorganization. The new structure and leadership roles are effective immediately, and we expect to transition to financial reporting under this structure by the end of the fiscal year, at which point we will provide recast financials under our new segments. Until then, I'll be walking through our results under the existing segments. Turning to parks, experiences, and products, we're thrilled with the results we achieved this quarter, with operating income increasing 25% versus the prior year to over $3 billion, reflecting increases at our domestic and international parks and experiences businesses. At domestic parks and experiences, significant revenue and operating income growth in the quarter was achieved despite purposefully reducing capacity during select peak holiday periods by approximately 20% versus pre-pandemic levels in order to prioritize the guest experience. Per capita guest spend at our domestic parks also showed strong growth. Quarter to date, park attendance at both Walt Disney World and Disneyland Resort are pacing above prior year. And based on reservation bookings, we expect to see this trend continue. Disney Cruise Line was also a meaningful contributor to the year-over-year increase in domestic operating income, reflecting higher occupancy in the existing fleet as well as the Disney Wish, which generated positive operating income in its first full quarter of operations. Domestic parks and experiences operating margins improved versus the prior year, despite increased costs from inflation, operation support, and new guest offerings, pressures which we expect will persist into Q2 and beyond. At international parks and experiences, higher year-over-year results were due to growth at Disneyland Paris and higher royalty revenue from Tokyo Disney Resort, partially offset by a decrease at Shanghai Disney Resort. At Disneyland Paris, we remain pleased with the positive results we're seeing from the substantial investments we've made there. And at Shanghai, results reflect the fact that the resort was closed for roughly a month during Q1 of fiscal 2023. Moving on to our media and entertainment distribution segment, operating income in the first quarter decreased by over $800 million versus the prior year, driven by year-over-year declines across direct-to-consumer, linear networks, and content sales, licensing, and other. However, we delivered a significant improvement on a quarter-over-quarter basis at our direct-to-consumer business as we progress on our path towards profitability, with Q1 operating losses improving sequentially by over $400 million from Q4. The sequential improvement at DTC was driven by higher revenue and lower SG&A costs, partially offset by higher programming and production costs. Notably, in the first quarter, we meaningfully reduced DTC marketing expenses across all three categories: content, brand, and performance. At both ESPN Plus and Hulu, subscribers and ARPU grew sequentially, with ARPU growth reflecting the impact of price increases that occurred in August and October, respectively. And at Disney Plus, core subscribers increased slightly, in line with our prior guidance, from 102.9 million in the fourth quarter to 104.3 million in Q1. Disney Plus core ARPU decreased by 19 cents versus the prior quarter, driven by an unfavorable foreign exchange impact and a higher mix of subscribers to our multi-product offerings, partially offset by a benefit from the recent domestic price increase, which occurred towards the end of the first fiscal quarter. There are a few factors worth mentioning that we expect will impact Disney Plus core subscriber and ARPU growth in Q2. The Disney Plus domestic price increase has been playing out as expected, with only modestly higher churn, which may also negatively impact the fiscal second quarter given the timing of the December price increase. That impact, in addition to slower than previously expected growth in some international markets, suggests core Disney Plus subs may grow only modestly in Q2 at a similar pace to the first quarter. As we have said before, sub growth will vary quarter to quarter, and we expect to see higher core subscriber growth towards the end of the fiscal year. Disney Plus core ARPU will continue to benefit in the second quarter from the domestic price increase. And while it's only been 2 months since the launch of the Disney Plus ad tier, we are pleased with the initial response, which includes continued demand from top-tier advertisers. As I mentioned last quarter, we do not expect the launch of the Disney Plus ad tier to provide a meaningful financial impact until later this fiscal year. And like Bob said, we are reaffirming our guidance that Disney Plus will achieve profitability by the end of fiscal 2024. Although, as I have mentioned before, our expectations are built on certain assumptions around subscriber additions based on the attractiveness of our future content, churn expectations, the financial impact of the Disney Plus ad tier and price increases, our ability to quickly execute on cost rationalization while preserving revenue, and macroeconomic conditions, all of which, while based on extensive internal analysis as well as recent experience, provide a layer of uncertainty in our outlook. We remain focused on showing incremental improvements in our DTC metrics, and we will continue to provide transparency into our progress and key drivers. In our prior earnings call, we noted that we expected the improvement in Q2 operating results at direct-to-consumer would be larger than the improvement in Q1. We now expect Q2 DTC operating results to improve sequentially by approximately $200 million, as improvements in the first quarter materialized more quickly than previously expected. Additionally, our view on Q2 now incorporates more challenging, addressable advertising headwinds. Moving on to linear networks. First quarter operating income decreased by approximately $240 million versus the prior year. Domestic channels operating income grew year over year, but that growth was more than offset by decreases at international channels. The increase at domestic channels was due to higher results at cable, while broadcasting results were comparable to the prior year quarter. Higher cable results were driven by lower programming and production costs, partially offset by decreases in advertising and affiliate revenue. The decrease in programming and production costs reflect lower NFL and college football playoff, or CFP, rights costs. The decline in NFL rights expense reflects the timing of costs under our new agreement compared to the prior NFL agreement, and lower CFP rights costs were due to timing shifts. Recall that we had 2 fewer games in the first quarter of fiscal 2023 versus the prior year, as those games were shifted into Q2 this year. The decrease in cable advertising revenue also reflects the CFP timing shift. ESPN advertising revenue in the first quarter was down 4% year over year, but was roughly flat once adjusted for the CFP shift. And quarter to date, domestic cash ad sales at ESPN are pacing slightly below prior year, when the 2 additional CFP games are adjusted out. Scatter pricing remains above upfront levels, although it has softened a bit in recent months. However, we are seeing solid advertiser interest for live events such as the Oscars, and demand across sports also remains solid. Total domestic affiliate revenue in the first quarter increased by 1% from the prior year, driven by 6 points of growth from contractual rate increases, partially offset by a 5-point decline due to a decrease in subscribers. International channels operating income decreased versus the prior year due to lower advertising revenue, an unfavorable foreign exchange impact, and a decrease in affiliate revenue, partially offset by a decrease in programming and production costs. As a reminder, the first quarter held no IPL cricket matches versus 13 matches in the prior year due to COVID-related timing shifts. Looking ahead to the fiscal second quarter, we expect linear networks operating income will decrease year over year by approximately $1 billion. We expect Q2 will have the most challenging comparison for linear networks versus the prior year, and anticipate a significantly lower decline in the back half of the year. There are several factors impacting the Q2 guide that I'd like to walk through. First, recall that domestic linear networks operating income increased in Q1 versus the prior year, benefiting from the timing of costs under a new agreement for the NFL and a timing impact for CFP. These impacts will work against us in Q2, and as a result, ESPN is expected to account for approximately half of the $1 billion operating income decrease. Broadcasting and our other domestic cable networks will be adversely impacted in the second quarter by approximately $300 million, driven primarily by headwinds in advertising and, to a lesser extent, affiliate revenue. And international channels account for the remaining $200 million decrease. This includes timing impacts from BCCI cricket, with 8 additional matches versus the prior year, other contractual rights cost increases, and additional top-line headwinds. And at content sales, licensing, and other, operating results decreased versus the prior year by $114 million, as higher theatrical results were more than offset by lower TV SVOD operating income, higher overhead costs, and a decrease in home entertainment operating income. These results came in below the guidance we gave in November, primarily due to softer than expected performance of certain theatrical releases. In the second quarter, we believe that content sales, licensing, and other operating results will be roughly break-even. Finally, before we conclude, I'd like to say a few words about our focus on allocating capital in a disciplined and balanced way. As Bob mentioned, over the years, we have invested in our businesses to drive growth and return meaningful capital to our shareholders. Despite the impact of COVID, which had a significant adverse impact on the company's free cash flow, our balance sheet is strong and supports ongoing investment in our businesses. We still expect cash content spend company-wide to remain in the low $30 billion range for fiscal 2023. The longer-term content cost reductions referenced earlier in the call are not expected to impact this year's guidance range. We also continue to invest in our parks and experiences globally and in other capital projects across the enterprise, and expect that fiscal 2023 capital expenditures will total approximately $6 billion. This is lower than our prior guide of $6.7 billion, primarily due to decreases in CapEx on our domestic parks, reflecting in part some timing shifts. Like Bob mentioned, given our recovery from the pandemic, strong balance sheet, and commitment to cost cutting, we believe we'll be on track to declare a modest dividend by the end of this calendar year. The amount will likely be a small fraction of our pre-COVID dividend, with the intention to increase it over time as our earnings power grows. And in terms of our current outlook, as we sit here today, we still expect that revenue and segment operating income growth for this fiscal year will be in the high single-digit % range, and we look forward to updating you on our progress as we move forward. I'd also like to note that shortly after today's call, we will be posting a presentation on our investor relations website, which will summarize many of the themes that we are discussing here today. And with that, I'll turn it back to Alexia, and we would be happy to take your questions.
Thanks, Christine. As we transition to the Q&A, we ask that you please try to limit yourself to one question in order to help us get to as many analysts as possible today. And with that, operator, we're ready for the first question.
Thank you, ma'am. And as a reminder, if you'd like to ask a question, please press star then 1 on your touchtone phone. And to remove yourself from queue, please press star then 2. Today's first question comes from Jessica Reif Ehrlich with BofA Securities. Please go ahead.
Thank you so much. Hi, Bob. As Christine said, it's great to have you back. It seems like a very different company than when you left, even though it was only a couple of years ago. Given the cyclical, but maybe more importantly, the secular challenges across all of your businesses, linear film, content competition, et cetera. So in the restructuring, what do you think are the quick fixes and what will take longer term to see the benefits of some of these actions? And on the $3 billion in cost cuts in content, is that largely fewer titles, and what does it mean for ultimate direct-to-consumer margins?
Jessica, thank you for welcoming me back. Let me take the second part of your question first. we are going to take a really hard look at the cost for everything that we make, both across television and film, because things in a very competitive world have just simply gotten more expensive. And that's something that is already underway here. In addition, we're going to look at the volume of what we make. And with that in mind, we're going to be fairly aggressive at better curation when it comes to general entertainment. Because when you think about it, general entertainment is generally undifferentiated, as opposed to our core franchises and our brands, which, because of their differentiation and their quality, have delivered higher returns for us over the years. So we think we have an opportunity to, through more aggressive curation, to reduce some of our costs in the general entertainment side and in general in volume. In addition, the structure is now designed to place responsibility of all international programming and investment in content in the hands of one unit, so that they can better decide the balance between what we make for global distribution and consumption and what we make for local distribution and consumption, with an eye toward possibly reducing expenses there as well as we balance better, obviously all designed to deliver the profitability that we talk about delivering by the end of 24. In terms of your first question, I mean, indeed, it is, times have changed, although in retrospect or in looking back at it, not in an extraordinary way. Obviously, it's gotten more competitive. The forces of disruption have only gotten greater. And there are certain things, certainly as a residual of COVID, that have just gotten tougher from a macroeconomic perspective. That said, we're still a company that is focused on creativity at its highest form. I love the fact that we are relinking the creative side of our business with the distribution and the monetization side of our business. And I think by doing that, we'll see the impact of that reorganization fairly quickly. But when I think about the secular change that we're going through, generally speaking, I like our hand. We have an ability to balance how we take our product to market with legacy platforms, whether it's movie theaters or multi-channel TV, with, of course, the streamers. We have an ability, and by the way, that helps us in a number of fronts, including advertising, monetization, stronger marketing. And so I think that when you focus on the company's assets in terms of our brands and our franchises, yes, it's a tough environment, but the combination of the restructuring and the fact that we've got these core brands, which when we get right creatively, as we've seen time and time again, not only differentiates us, but enables us to deliver fairly strong returns.
Thank you.
Thank you. Next question.
And our next question comes from Ben Swinburne with Morgan Stanley. Please go ahead.
Thank you. Good afternoon. Bob, I'm sure one reaction you'll get today from all this news is, the future of television, I think, is viewed as being streamed, with linear obviously declining. I'm sure you generally agree with that trend. So how do you think about that, about your strategy as you've laid out today in the context of that, to make sure you're maximizing the returns globally of the franchises that you've built? And then I was just wondering, maybe, Christine, on the parks business, really strong margins this quarter, really kind of the return to the kind of incremental margins we're used to seeing. Didn't sound like there was anything one time, but I just wanted to ask if this quarter is sort of emblematic of kind of how you see the rest of the year playing out from a trend point of view. Thank you both.
Thanks, Ben. Nice to hear from you. I've been watching this very carefully for a long time. And what I'm talking about is the impact of technology is basically creating a huge authority shift from the producer and the distributor to the consumer. And as that authority has shifted, it's made the traditional business more complicated, more challenging. And when you think about what streaming is, and we talked about this a lot as it related to multi-channel TV, it is the ultimate a la carte proposition for the consumer. It gives the consumer so much more authority than they ever had before, because in reality, it gives them the ability to watch programs, not channels, not even bundles when you think about it. And because you're signing up in most cases for a 1-month subscription, you can sign up for one program, pay a relatively small amount of money, and then end up basically unsubscribing.
That's tremendous change. And I think what's going on right now is that as the linear business continues to erode, we've been basically eyes wide open on that. Christine commented about some of the challenge related to that. The streaming business, which I believe is the future and has been growing, is not delivering basically the kind of profitability or bottom line results that the linear business delivered for us over over a few decades. And so we're in a very interesting transition period, but one I think is inevitably heading toward streaming. So the way we're basically contending with it, and we've alluded to it today already, is that, and this I think is also directly related to our restructuring, we're going to rebalance a bit because those linear channels and movie theaters too still can provide us with significant amount of monetization capability. They enable us to amortize the cost better over multiple platforms and create some marketing clout. You think about it, Abbott Elementary airs on ABC, then it goes to Hulu. The demographic difference in age is tremendous. It's like 60 years old or around, I'm estimating, on ABC, and in the 30s on Hulu. That's a perfect example how the linear platforms, while they still have an audience and can help us monetize, can still be used effectively, and we have that ability. And so we're going to monitor it very carefully. We're not in any way stepping away from streaming. It remains our #1 priority. It is, in many respects, our future, but we're not going to abandon the linear or the traditional platforms while they can still be a benefit to us and our shareholders.
So Ben, great to hear your voice, and I'll address the parks question. So as I mentioned in my comments, we were really thrilled with the performance of parks in the quarter. There were no one-time items to call out, but the one thing I would mention is in previous quarters, we had mentioned that the recovery from the pandemic in our international parks was lagging domestic. And in this quarter, we had very strong performance, especially year over year, from Disneyland Paris. We had the opening of Avengers Campus over there in July, and that is incredibly popular and driving attendance. And we also have a new hotel that was actually an old hotel that was redone into the Art of Marvel. Again, very popular and attracting a lot of consumers to come out and experience that. The other thing I mentioned was the strength at our royalty stream from Disneyland in Tokyo. And the other thing not to forget is this quarter, our first quarter of the year, is seasonally one of our strongest when you look at it relative to other quarters. But the year-over-year comparison, it was an improvement, and we feel great about our business going forward.
Thank you both.
Thank you. Next question.
Our next question today comes from Michael Nathanson at SVB MoffettNathanson. Please go ahead.
Thanks. Welcome back, Bob. I have two. The first is, when you go back to the second investment day you had for streaming, the company increased their TAM forecast, their investment spending, and kind of vision for Disney+. Now that you've returned with more data and time, what's the vision for Disney+? You know, you don't want to give us long-term targets, I get that, but what is the product vision? Is it a more narrow vision? Any type of long-term size of the investment and the long-term profitability case of D+ would be helpful. And then on linear, the bench question, a big part of the cost structure of sports costs, you've signed a ton of them lately, but when you think about going forward, can you help us understand what will change going forward on sports rights investment in terms of must-have and not necessarily must-have? Thanks.
Well, the second question, as you know, we've locked in a number of deals already, including some of the biggest ones, which is in college football with the SEC, as well as with the NFL. The one that's looming is the NBA. I know that's on people's minds, which is a product that we've enjoyed having and hope to continue to enjoy having, because not only its volume, but its quality. ESPN has been selective in the rights that they bought. I've had long conversations about this with Jimmy Pitaro, and we've got some decisions that we have to make coming up, not on anything particularly large, but on a few things. And we're simply going to have to get more selective. ESPN Plus actually has grown nicely for us, and it's shown us that the ESPN brand can be enjoyed and can be expressed well as a streaming brand. And I think that we are going to continue to look at that as a potential pivot for ESPN away from the linear business. But we're not going to do that precipitously. We're not going to do that until it really makes sense from an economic perspective. On the first part of your question, what's changed or where are we headed from what was the second investor day? I think a few things. First of all, we were, as a company, in a global arms race for subscribers. And it was the number of subscribers that had become kind of the primary measurement of success, not only here in the company, but in the investment community. And in our zeal to go after subscribers, I think we might have gotten a bit too aggressive in terms of our promotion. And we're going to take a look at that. I listed a number of things on the call. That's one of them. I talked about pricing as well. That's another, where we really have to look at, are we pricing correctly? It's interesting, as Christine noted, we took our pricing up substantially on Disney Plus, and we didn't suffer any de minimis. We only suffered a de minimis loss of subs. That tells us something. It may also tell us that the promotion to chase subs that we've been fairly aggressive at globally wasn't absolutely necessary. So pricing is definitely one thing. Promotion obviously is tied to that. It's also obvious to us that we can't get to profitability and turn this into a growth business without growing subs. So while we're taking off the table sub guidance, we're still going to look to grow subs. We just want to grow quality subs that are loyal and where we actually have an ability to continue to price effectively to those subs. In addition, we're going to lean more into our franchises, our core franchises, and our brands. I talked about curation and general entertainment. We have to be better at curating the Disney and the Pixar and the Marvel and the Star Wars of it all as well. And, of course, reduce costs on everything that we make, because while we're extremely proud of what's on the screen, it's gotten to a point where it's extraordinarily expensive. And we want all the quality. We want the quality on the screen, but we have to look at what they cost us. So we're going to continue to go after subs, but we're going to be more judicious about how we do that. We're going to look carefully at pricing. We're going to reduce costs, both in content and, of course, infrastructure. There's a lot that we're getting at there. Marketing is another area. We're going to try to rebalance marketing of the platform versus marketing of the programs. Nielsen came out with something a few weeks ago that was stunning to us, and that was that 10 of the top 15 movies streamed in the United States in 2022 were ours. On that list was Moana and Zootopia and Frozen, but also Turning Red and Encanto. That suggests to us that our brands and franchises work extremely well in streaming. I mentioned how Wakanda Forever has done as well. So core brands and franchises, more efficient pricing, getting better at marketing, being a little bit more judicious at promotion, all of those things is how we believe we're going to get to turn the streaming business into a growth business. And one other thing, the streaming business is going to continue to grow, albeit at the expense of linear programming, but consumption of television is not decreasing, is actually going up.
Thank you.
Thanks,
Next
Bob.
question.
And our next question today comes from Philip Cusick with J.P. Morgan. Please go ahead.
Hi, thank you. Bob, following up on Michael, there's been a lot of talk in the last year about whether Disney should keep, spin, sell, or trade ESPN. With it now as a standalone segment, can you give us your view on the future of Disney and sports in particular, and maybe TV in general? How integral is ESPN to the company's future? Thanks.
Thank you, Phil. We were fairly certain that when we created this structure and broke ESPN out on its own, that it would lead to questions like this. We did not do it for that purpose, actually. ESPN is a differentiator for this company. It's the best sports brand in television. It's one of the best sports brands in sports. It continues to create real value for us. It is going through some obviously challenging times because of what's happened in linear programming. But the brand of ESPN is very healthy, and the programming of ESPN is very healthy. We just have to figure out how to monetize it in a continuing or disrupting world. That's it. But we're not engaged in any conversations right now or considering a spinoff of ESPN. That had been done, by the way, in my absence, and I'm told the company concluded after exploring it very carefully that it wasn't something the company wanted to do.
Thank you. Next question.
And our next question today comes from Doug Mitchelson with Credit Suisse. Please go ahead.
Oh, thanks so much. Welcome. I'll have my welcome back, Bob, comment. Bob, there's some investor, skepticism that theme park per caps and margins are elevated due to post-pandemic benefits that might expire. I'm curious, in your view, does the theme park division still have healthy growth prospects, from here, especially after, pretty good quarter this quarter? And what do you see as the major growth drivers of theme parks going forward? Thanks.
Nice to hear your voice again, Doug. We've been through many of these calls in the past. Well, the answer is yes on the theme parks in terms of their growth. I'm very, very bullish about our parks. And not just because of the COVID recovery, but to start with, demand on the parks is extraordinary right now. Now, we could lean into that demand easily by letting more people in and by more aggressively pricing. We don't think either would be smart, because we let more people in is going to reduce guest experience. That's certainly not what we want. And in fact, if you looked at our results this past holiday season, we actually reduced capacity, certainly improved guest experience, and we're able to maintain not just profitability, but very, very successful or robust bottom line. We're going to continue to look at opportunities like that, which is essentially to simply get more creative in terms of managing the capacity that we have. I'm going to come back to that in terms of growth, but let me also address the pricing side. It's clear that some of our pricing initiatives were alienating to consumers. I've always believed, by the way, that accessibility is a core value of the Disney brand. We were not perceived to be as accessible or as affordable to many segments as we probably should have been. So after basically paying heed to what we were hearing, we started to address it. And the steps that we took were actually were very, very positive. We got really great reaction to it. In addition, and it's tied to this, is that we've put in place just basically more flexibility for the consumer in terms of how much it costs them to go. And interestingly enough, if you look at the increase of the core ticket at, say, Disneyland, it has not really increased that much, maybe slightly ahead of inflation over the last few years. But one of the things that was interesting to me in coming in and examining our pricing is we were making that available to people for only 15 days a year. So if you look at our new pricing strategy, we made it available for, I think it was 50 days a year. And so we greatly increased accessibility to our lowest price. And it's really well received. So we're going to manage capacity very, very carefully. Some of that, by the way, has enabled us to essentially shift mix from annual pass holders to people who may come just once in a lifetime or once. They tend to be good customers of ours because of their per cap spending when they're there. That's really helpful. Some of the things that we put in place to manage basically annual pass holders was done to help us manage capacity without doing too much damage to the bottom line. Lastly, we have learned that when we invest in increasing capacity, the Star Wars lands would be a good example of that. Pandora was a great example of that. We can grow our business. In fact, if you look at the results when we put Pandora at Animal Kingdom, from year to year, they were stunning in terms of how many more people visited Animal Kingdom. I mentioned on the call that we're going to bring a version of Avatar to Disneyland. We have other opportunities as well. I've talked to Josh tomorrow about this very recently, like this morning, again, to really look at all the great franchises of the company and see where we can invest in them in the parks to increase capacity while preserving guest satisfaction.
Thank you.
Operator, I think we have time for one more question.
Thank you. And our final question comes from Stephen Cahill with Wells Fargo. Please go ahead.
Thanks, Bob. I'll ask you a question that we've asked Christine a lot over the last year, which is, you made the comment about ESPN Plus expressing some success in streaming and sports. And, there's probably now about 40 million homes who've decided to not be in the bundle. So what do you need to see out there in the linear world to decide that an ESPN a la carte sports service in streaming should be the big leap for Disney. And then just a small one, you mentioned about how a lot of content can amortize in places other than streaming. You talked a lot today about cost cutting. Should we think about licensing as also being a potential sort of big profit pool over the next few years? Thank you.
I'll take the second part first, Steve. The answer to the second part is yes. Now, when you say big, I don't know yet. I mean, we're not really there, but when we bought Fox, we greatly enhanced our television production and film production capabilities, bringing into the company great talent in both the movie and the TV side. As I've talked about getting more aggressive at curating general entertainment, by the way, we're not getting out of that business, but we're going to curate it more. We have opportunities using the great talent that we have to create for third parties, and we're going to look at that very seriously. I actually think there's a nice opportunity to create a growth business for the company, but it's way too soon to predict what that can be. Regarding ESPN and when we might make the shift, if you're asking me, is the shift inevitable? The answer is yes, but I'm not going to give you any sense of when that could be, because we have to do it obviously at a time that really makes sense for the bottom line, and when we're just not there yet. And that's not just about how many subscribers we could get. It's also about what is the pricing power of ESPN, which obviously ties to the menu of sports that they've licensed.
Thank you.
Okay, thanks for the question. I want to thank everyone for joining today. Note that a reconciliation of our non-GAAP measures that were referred to on this call to the equivalent GAAP measures can be found in our investor relations website. Let me also remind you that certain statements on this call, including financial estimates or statements about our plans, guidance and expectations, beliefs, or business prospects, and other statements that are not historical in nature may constitute forward-looking statements under the new security laws. We make these statements on the basis of our views and assumptions regarding future events and business performance at the time we make them, and we do not undertake any obligation to update these statements. Forward-looking statements are subject to a number of risks and uncertainties, and actual results may differ materially from the results expressed or implied in light of the variety of factors, including economic or industry factors, execution risks, including in connection with our organizational structure and operating changes, cost savings and efficiencies, workforce reductions, and DTC business plans relating to content, future subscribers, and revenue growth and profitability. For more information about key risk factors, please refer to our investor relations website, the press release issued today, the risks and uncertainties described in our Form 10-K, Form 10-Q, and other filings with the Securities and Exchange Commission. We want to thank you all for joining us and wish everyone a good rest of the day.
All right, guys. So that is the Disney earnings call. Again, hit that subscribe button. We're very close to 100K. We might hit it this week. We might hit it next week. But within the next week, we're going to hit 100K. We still got 400 people here. So, hey, hit that subscribe button if you haven't already. We certainly appreciate it. Also, guys, check out Top Step. Disney's sitting right at 118 now. One of the ways you can trade, essentially stocks in a way through the S&P 500 is in futures. You can see this left side here is the futures market. There's no PDT in futures. You can day trade short futures without restriction. And Top Step is the most legit futures funded program in the world. They pay out millions, fund thousands a year. They are a sponsor of mine, and so I'm definitely biased in their favor. But what they do is they give you a demo and they test you. And if you can hit their targets while following their rules, they fund you between $50,000 to $150,000 with a 90% split. They pay out millions of dollars every year in actual withdrawals. They're the most legit funded program in the world. And the beautiful thing is that a lot of traders are not going to get funded. A lot of traders are going to lose the challenge. And that's good, because if they tried it with real money, they would lose so much more. And it genuinely tests your skill. It teaches you how to trade under pressure. It's a perfect middle ground of pressure where it's not the end of the world if you lose it. The base one's less than $140 a month. But if you can pass it and get funded, there's a 90% split and a ton of other benefits. So check it out. Here is the link. Great way to help support the channel. Y'all be safe. I will be back tomorrow bright and early. Disney flying up. I've been calling out Disney since $85. Got a lot of hate, but hey, listen, when you're right, you're right. The haters will never admit we were right. And yeah, it looks good, man. Hey, when you're right, you're right. And top 3 greatest traders of all time. We'll see you guys tomorrow. Good luck. Again, y'all subscribe. Help us hit 100K. We got jobless claims tomorrow, which will influence the market. And we will be streaming that data completely live like we always do. So, hey, subscribe, hit the notification bell. I'll see you all later. Y'all get some sleep. And yeah, we'll see you guys tomorrow. Good luck.